afternoon, everybody. Welcome to our webinar this month. You can see by the topic there, do you leave money on the table by ignoring corporate actions? So the whole topic is about corporate actions. I handle the corporate actions for PSG Wealth, and I've been very frustrated with people's missing opportunities. So hence the reason for this webinar. So also we saw that last year, we saw the saga unfolding around NASPAS and process, which left many shareholders obviously perplexed as to what to do with the shares. We also saw it more recently with Billiton, when Billiton moved from BHP Billiton to BHP Group. Obviously, that also triggered a gains tax event for a lot of people, and a lot of people were upset about it. So yeah, there's quite a few things that do affect people, affect our clients. So we came back to process and NASPAS. The market did not like it, and obviously there was a lot of negative sentiment, and that negative sentiment at that point in time was reflected in both share prices declining. I'm talking about last year. More recently, we saw what happened with EOH when they had a rights issue. So I'm going to spend a lot of time today discussing the rights issues, and I think that's where when I say do you leave money on the table, I think there's opportunities with rights issues that a lot of people are missing because they don't understand it. So when a transaction is less advantageous than desired, it is said that you're leaving money on the table. That's where I got that expression from. So many small investors, direct clients, for example, miss out on opportunities, as I mentioned just now, because they do not understand what is required of them, especially when it comes to corporate actions. So please join me. My name is Sean van den Berg. I'm an investment specialist here at PSG Wealth as we discuss these corporate actions. Okay, so here's my little agenda. Very quickly, what is corporate actions? What are non-elective and elective events? That's the most important one. Elective, what must you do? And then we're going to discuss very quickly some common types of corporate actions. Okay. So let me just have some water here quickly. So what is a corporate action? So a JSE listed company, for example, may from time to time make changes to their issued shares, okay, or issued share capital. And this type of event is called a corporate action. So corporate actions is any event which has a substantial effect on the share price or the shareholders' rights. So it's very important that you're aware of these things, okay? So in other words, any action conducted by the company that changes the company can be considered a corporate action. So you as a shareholder have a right to know about these corporate events. So these actions obviously convey the company's position to shareholders. So when I talk about issued shares, by the way, it means the company's total number of ordinary shares held by investors. You've got authorized capital and you also got issued shares. Okay, that's what we're talking about. The shares available in the marketplace and mostly held by obviously shareholders. Yeah. So when we talk about what are corporate actions, there are three main reasons why a company would have a corporate action. Number one, obviously to return profits to shareholders. The most common one would be cash dividends, when a company declares dividends. And obviously that's declared by the directors of the company as and when there's profits available. That's number one. Another example would be share splits. Okay, there's another case where a shareholder is rewarded. But it's saying that in a stricter sense, the share split or bonus issue, we'll discuss it in more detail just now, should not impact the share price, but in rare cases it does, and it results in the overall increase in value. And we'll go into more detail, as I say just now. The second example there is influence the share price. So if the share price is too high or too low, the liquidity of the share suffers. So a share price too high will be not affordable for investors, and as I say, we'll go into more examples just now. Or if the share price is the share is too low, there might be a fear that the company might be delisted. Okay, so it's under the radar screens of a lot of people when it's call it a penny stock. So share buybacks are another example where it will affect the share price, and as I say, I'll go into more details of that. And the third reason there why a company would have a corporate action is corporate restructuring. Usually it comes to a payout, be it cash payout or a dividend payout, but the restructuring in order to increase profitability. So that is the main thing there. Examples would include mergers where two companies that are competitive or complementary join forces, and there's spin-offs. When we talk about a spin-off, we talk about unbundling. The company breaks itself up in order to focus on its core competencies. Okay, so those are all examples of why a company would have a corporate action. Okay, so here's obviously there's impact, impact on the shares. For example, going back to just now, a dividend payout will have a direct financial impact on you as a shareholder. A share split will have an indirect impact on you because it increases the liquidity. It might cause the price to either increase or decrease because of that liquidity. And the third one, another one would be a name change will have no impact on the share as such. Okay, so when we talk about corporate actions, they fall into two broad categories. We talk about non-elective and elective events. In other words, you can say non-elective is mandatory, whereas an elective is voluntary. Okay, so when it comes to mandatory, shareholders effectively have no choice. Okay, you have a company that does it, it's mandatory. You have no choice in your participation, where you also have, sometimes you'll have what they call a mandatory with options. This is where the board of directors carries out that action, but provides you as a shareholder or the investor a choice of options. And in the third scenario, as I said, there is elective or voluntary. This is where you decide if you want to participate in the action or not. Okay, so we'll go into more detail of that. So when we talk about the non-elective or mandatory events, as I say, this is where you don't have, you don't have a choice. You're a passive participant in the event. So, for example, dividends, name changes, delistings, etc. So, cash or shares and/or cash positions of each shareholder were impacted in the same fashion. Okay, so it's a blanket action, etc., a blanket event. Okay, so that's a very broad way of looking at it. Mandatory with options. Now, this is where it gets a bit more. When I say mandatory, another way of looking at it is compulsory or obligatory. In other words, it's required by law or rule. That's what I mean by mandatory. So these events offer the shareholder a choice as to how to participate in the event. So remember, this is mandatory with an option event. So shareholders are either given two or more options. You can either take a combination of shares and or cash. If you don't do anything, by the way, the default option will come, whatever the issuer decides, the default option will be taken. So, for example, dividend reinvestment plans, DRIPs, we call them DRIPs, or spin-offs or unbundlings. These are examples of mandatory events with an option. But be aware of it, and I'm going to stress this right through the webinar. Be aware of these events. How do you stay aware of it? Keep your eye on SENS announcements, stock exchange, new service events, and things like that. So keep in touch with what's happening with your company. Okay. When we talk about voluntary events, this is where you as a shareholder are required to respond. So there's a response or more action from a shareholder. So you're provided with a choice of options. You must respond. Okay. So this is where participation is mandatory. It's compulsory. Okay. So the company can't move forward until you as a shareholder. Remember, those are the main, or the big, you as a shareholder are the main owners of a company. So you have to make a decision. So shareholders that do not take action, okay, remain unaffected by the event. Okay, when I say unaffected, I put it in inverse. We call those things. Okay, remain unaffected. I put it in inverted commas. For example, company may declare dividend option to shareholders, an option to elect or receive a cash dividend, or an option to elect and receive fully paid up new shares in the company. With the default option is a set of new shares. So if you don't do anything, you automatically get it. Okay. So the eligible shareholder will need to make a valid election by the election deadline. if he wants to obviously receive the cash dividend or new shares. Okay, so beware of those events. Look at the email, and then decide if you want the cash option. That's not the default. Then you have to make a decision, and obviously alert us to that. Should a shareholder not make a valid election, as I say, the shareholder will automatically receive new shares in this example. Okay, so let's go into more detail. Let's talk about some common types of corporate actions. So when a public traded company or JSE listed company issues a corporate action, it is doing something that will affect its share price. So this is why I want to highlight this. Be aware of these events because it does affect the share price and obviously your shareholding. Okay, so why do they do it? It's a good way to look at it. If you're a shareholder or considering to buy shares in the company, you need to understand how the action will affect the company's share price, number one, or number two, to tell you a great deal about a company's financial health, and obviously its short-term future. Okay, so company actions include, there's a lot of examples and we'll go through it now. Remember, these things are all decided by the board of directors of the company, but you as a shareholder have to approve them. Okay, so the common types, obviously name changes comes to mind. They're very easy. Allied Electronics changes its name to Altron, but it obviously kept the share code. And today also there was a corporate action that came out, name change for all the new funds. They all changed their names to Satrix. Satrix obviously has bought them out. So those are just very basic ones. And then unbundling. When a listed company has one or more subsidiaries, listed or unlisted, it gives the shareholders cash or shares. Example would be Old Mutual when they unbundled Nedbank shares. For every 100 shares you had of Old Mutual, you got some Nedbank stocks. So those are some examples. I'm going to go through this very quickly. Obviously, when you get this PDF or the recording, just go into the more details of the examples. Okay. Mergers, this takes place when two separate companies consolidation to a separate company. Most popular one or most prominent example would be Anheuser-Busch InBev when they bought SA Breweries. That would be a very popular one. Acquisitions, more recently we saw PepsiCo buying all the remaining shares that it didn't have in Pioneer Foods. It was a big deal with about 24 billion. And in delisting, this is a removal of a listed share from the JSE. So consolidated infrastructure was one of them. We saw very recently, and there's been quite a few over the years. Just understand with delisting, and I spent some time on it, this is a red flag. So if a company's share price has been dropping, okay, that's number one, because it's unprofitable and or a whole lot of kind of stuff. You as a shareholder must start making decisions about this. So a delisting can be voluntary or involuntary, and there are many reasons, good or bad, for a company to delist. Be aware of these things. So that's why I say keep up to date what's happening with your company. Keep your eye on the SENS announcement. So one of the other things, one of the reasons would be that a company fails to file its financials reports in time, or doesn't meet listing requirements. There's a lot of different reasons, and there's quite a few examples recently. It may also be the lower than required share price and obviously insufficient market capitalization. The company's become too small and it's too expensive to have a listing on the market. All those kind of things you have to be aware of. Usually a delisting occurs when the company ceases operations, declares bankruptcy, as I say, these are all red flags, merges with another company, and seeks to become private. There's also some examples of that. I remember years ago, Edgar's, and there was Console Glass and things like that. So when a share is delisted as part of a merger or due to a company taking it private, you have limited time to sell your shares before you convert it to cash or exchange acquiring shares, obviously at a predetermined conversion rate. One thing I want to highlight for you, you cannot trade delisted shares. Okay, so not delisted, unlisted shares. You cannot trade unlisted shares. So just be aware of those kind of things. You need to make a decision before that. Okay, let's talk about dividends. We spoke about it very briefly just now. Dividends obviously paid out of the company's profits, or out of retained earnings. The different periods, you get the interim, which is the first 6 months, and then you get the final, which is at year end. Sometimes the company has too much cash and they don't know what to do with it, and they'll declare a special dividend. Okay, So dividends are paid on a per share basis. So here's an example there. ABC declares a dividend of 42 cents. And this is obviously expressed as a percentage of the current share price. So the current share price in this example is trading at 5 Rand a share. So that 42 cents divided by 5 Rand, you'll get a dividend yield of 8.4%. You can compare it loosely to the return you can get in the bank, the interest rate you can get in the bank. So it's very important. Remember, this is before dividend withholding tax, so less 20% on that 8.4%. So, but it's another way of just looking at how attractive the company would be as a generator of future profits and things like that. Okay, scrip dividends. I want to spend some time on this. Sometimes, well, scrip dividends are thought to be more superior than cash dividends if they are not accompanied by cash option. Why would a company pay scrip dividends? The reason for that is it's giving the shareholders a choice of keeping their profit or turning it into cash whenever they desire. So you've got a flexibility down the line to sell your shares, as opposed to if you had just had cash now, you've got your cash already. But the main thing is the company would have a scrip dividend or issues more shares when it has not got cash. In other words, it's not sufficiently liquid. It's strapped for cash. So you can also read a lot into this. Is it good or bad? You decide. Okay. But the main advantage is obviously it gives the company flexibility when it wants to pay a cash dividend. So down the line, I want to conserve my cash right now. I'm going to give you some more shares. Down the line, I might start paying more cash. But you as a shareholder have this great option to increase your ownership in the company. Okay. So remember, this is just an option for you that you can take advantage of, where you're going to get additional shares in the market. Okay, so it's great. And obviously there's no brokerage costs involved with that. Another thing to look at. Okay, then I want to spend some time on this, what they call DRIPs, dividend reinvestment plan, or DRIPs. Okay, what's important to know here also, it's another way for a company to allow shareholders to acquire more shares cheaply, because there's no brokerage costs involved here. So just be aware of that. So or sometimes it might be a little bit brokerage cost, but the main thing here is you're acquiring more shares, you're getting the cash dividend, they're accumulating all the cash together, and the company themselves goes and buys the shares in the market. Okay, so that's why I'm saying there's no dealing costs there. You might pay a management fee and things like that, but there's no brokerage costs. But the main thing here also is that just be aware that the cash dividends reinvested into DRIPs are still considered taxable income by SARS. Okay, so yeah, just be aware of that. Let's talk about a share split. Another way of looking at it also, what they call a bonus issue. As I say, this is where you might have an indirect reward. So the company, all it does is creating more shares in the market by dividing the existing amount of shares in the market. So it increases the number of shares in issue or creates more liquidity in the market in general. So the main thing here is that without issuing new shares, it splits existing shares. So the whole idea here is, as I say, you want to lower the trading price to make it more affordable for most shareholders or most investors out there. Okay, so it increases the liquidity of the share. It has no effect on the company's worth, as is, if you look at it measured by market capitalization. It doesn't change that anything. So I'll show you some examples just now. But the main thing here also is that the 2-for-1 share split is the most common way of looking at it. You're basically looking at a company cutting its own share price in half, where you as a shareholder will obviously get double the amount of shares, but at the same value. Okay, so let's have an example. Naspers, trading in the market, and I'm using an example, it's trading in the market at 2,350 Rand a share. You own 100 shares. So the value of that holding or that position is 235,000 Rand. Okay, for the normal man in the street, way out of the league. So after 100-for-1 share split, you'll have 1,000 shares. So it's your 100 shares times 10. If you have the 10 Rand, that would be equal to shares at 235. So it's still the same value, but obviously now 235 Rand a share as opposed to 2,350 Rand a share. You as a smaller shareholder can go buy 40 shares in the market at 235, 235 Rand a share could cost you about 9,500 Rand. Okay, that's what makes it attractive. But you as a normal shareholder, instead of having 100 shares, now you have 1,000 shares, same value, doesn't affect it. I remember a few years ago, same thing would happen with Apple. They had a 10-for-1 split. It was $700 a share at a 10-for-1, went down to 70 bucks. More people got involved and the share price went up. Okay. Then we have the opposite when we talk about share consolidation. We can call it a reverse share split. This is where the share price has fallen and where the company's worried about delisting. So they'll have a share consolidation. Another reason for a share consolidation, they might want to tidy up the share capital and reduce the number of shares received by a certain amount. So they might offer you as a small shareholder odd lot and take the shares off the market. Okay, so that's the whole idea, is that the share price becomes higher, but your shareholding becomes less. So, for example, you have Aveng, building construction company, at a 1-for-10 or 1-for-100 consolidation. The idea was to reduce a 60 billion shares in issue. Okay, so that was the reason there. Then share buybacks. This is where a company repurchases its own shares from a specific or defined shareholders, in other words, the marketplace. So I look at it as a positive, because the company's buying back its own shares. You know, the company can't act as its own shareholder, so that's why they do this. So the repurchased shares are absorbed back into the company, and obviously the issued share capital is reduced. So if the issued share capital reduced, that means the relative ownership increases, and obviously the earnings of the company increases. So that's where you get the benefit of that. The buybacks are in two ways. Obviously termination. This is where the listing of the JSE is with the company is delisted. They buy the shares back from you, they give you the cash, and delist the company. Unbundling, we spoke about it before. Company distributes in specie to the registered shareholders the amount of shares. Okay. Then I want to spend some time on this rights issues. As I said, we had a scenario last week or the week before. We had EOH. Today we got we're having some problems with sound here. You guys can still hear me? Say yes. Okay, sounds like my call quality is dropping here. Okay, cool. You guys can still hear me. Awesome. Okay, so what is a rights issue? It's just where the current shareholder is invited by the company to buy additional shares. In other words, you take up your rights in that company, and usually there's incentive, because the new shares are offered at a reduced price as the incentive. Okay, so this discounted price is it's only for a short period of time, usually about 6 weeks, after which it returns back to normal. So this allows the company to raise additional capital. So remember, when the company first listed on the market, we issue some shares. Rights issue is another way of issuing more shares to raise more capital. Okay, so company would usually use this funding or this capital to clear debt, or to acquire more assets, or to facilitate expansion. Okay, without having to go to the bank and getting loans and paying interest on that. So that's the reason why we have a rights issue. The rights issues are made by means of what they call a renounceable letter of right that is sold. So that's tradable. That's taken up at a predetermined price or lapsed. So those are the decisions you need to make. And they issue what they call a null paid letter, which may be taken up at a predetermined price or lapsed. Main thing to do with a rights issue, and I'll highlight this for you, you must do 3 things. You either take up your rights, you sell your rights, or you do nothing and be aware that it's going to lapse. Okay, so be aware of those scenarios. Okay, but a rights issue, you need to do some action. Okay, even just being aware that you're going to lapse the right. So you take up the price. It's usually, as I say, offered at a discount. We'll look at some examples just now. But if you don't do anything, you lapse your rights. Just be aware of that. So null paid or NPLs, they trade in the market like a normal share. You can buy and sell them. You're just basically given a right. There's additional shares, and that's another way of looking at it, is what they call a right. Okay. So you need to exercise your rights. Okay, as an example, let's say you as an investor own 100 shares in company ABC. The shares are trading 100 Rand, at 10 Rand each. The company announces a rights issue of a ratio of 2:5. Each shareholder holding 5 shares will now be eligible for 2 new shares. And these new shares, remember the current shares are trading at 10 Rand. New shares are being offered at a big discount at 6 Rand a share. So that's an incentive. So for every 5 shares at 10 Rand each, held by existing shareholders, the company will offer you 2 shares at the discounted price of 6 Rand a share. So here's an example. You as a shareholder have these shares, these 100 shares at 10 Rand. There's in your portfolio and they're worth 1,000 Rand. Very simplified example, but I want to get the point across. So the rights issue comes across. So for every 100 shares you get, you'll be offered 2 shares. For every 5 shares you own. Okay, so in this scenario, those 100 shares you'll be offered to get the rights of 40 additional shares. So the advantage here is that you can buy those 40 shares now at 6 Rand, which is 240 Rand. Okay, so after the shareholder, after the rights issue, you exercise your rights. You'll have 100 shares plus your 40 shares that you just got down the rights issue. You'll have 140 shares. So that 140 shares, the value will be 1,240. So theoretically, you take that 240, that 1240 divided by the number of shares in issue, the number of shares you hold now. The share price will be 8.86 Rand. Okay, so remember the shares were at 10 Rand, now they're 8.86 Rand. So according to theory, the price of the share after the rights issues should be 8.86 Rand, but this is not how the market behaves. In an uptrend, the share price will benefit the shareholder, where when the price falls below this 8.86 Rand, obviously you'll be losing some money. Okay, so just be aware of that. So the decline in the share price can be attributed to several factors. The 2 main reasons: it gives you a signal to the market, that the company may be struggling. Okay, remember that sentiment moves the market, how people feel about future prospects. So it might be a signal that the company might be struggling, and that's the reason, obviously, why they're issuing more shares at a discount. Another way of looking at it, they're desperate to raise capital. Another way of looking at it, they're issuing more shares, and obviously this dilution in available the number of shares. Okay, so that's another way of looking at it. Okay, so more recently, as example, this is EOH, the share price. You can see how it's been dropped. So more recently, you can see over the long term has been moving sideways, drop, sideways, drop, sideways, drop. Sorry, I should bring my little cursor in here. Spotlight. This is what they call a 200-day moving average. So when the share price trades below 200-day moving average, the trend is bearish. So this has been bearish for quite a while. These 2 other lines is a 21-day, that's the red line, and the 40-day. So you can see all right now, you can see with the rights issue now how this gap done. You can also see the volume. Having open for the share for a long time, and with this whole rights issue, there's been lots of volume. So this could be going from weak hands to strong hands. The rights we offered at 1.30 Rand. You can see we went as low as 1.50 Rand. Okay, so you as a shareholder or a potential shareholder in EIH, you have to say what the future growth prospects, for the company. I know they've got new management. I know they're using the rights issue to get rid of debt. So I would say this is a speculative trade for me. It'll be more of a short term. I'll be seeing if it breaks out of the sideways market here. It has to close this gap before I really get excited. Changing trend. So these 2 moving averages have to cross each other. So it's still a long way to go before I would get excited about getting involved in EOH. Okay, so I just wanted to highlight to you the effects of what happens with the rights issue and what happened, the perception of the market. Okay. Cool. Guys, I think I've run out of time. So I'm just going to go back to normal. And let's look at a quick summary. The main thing I wanted to highlight for you is that a corporate action has a substantial effect on the share price and you as a shareholder, your rights. Please be aware of these corporate actions. So the best way to be aware of this is going to PSG Online. and follow what we call the sense announcement, stock exchange news service related to your company. So what I suggest is create an alert. It's called in your watch list or next to the company. On the far left hand side, you can click on the button there and you can add alert. Okay, alert, or especially when it comes to sense. So you get an email when something comes out. Email to bounce back. At least 60% of the time, emails bounce back are delivered. Okay, so please make sure that we have your correct email address on record. Okay, so please contact our client service team at psg.co.za, or you can also give them a call 0860 4444, and make sure. The reason I'm saying they're gonna you're phoning, they're gonna validate who you are, verify who you are to change your email address. That's what's important. Please make sure that we got your right email address on record. Okay, so from my side, I hope you've learned something today. I know I've gone through it very quickly. Let me see what kind of questions you guys have. If you've got any questions, you're welcome to drop me an email, wealth@psg.co.za. You can also find me on the OneStream line there, 0860 000 368. That's for the direct team, and I'm there to help you. Okay, so let me see what kind of questions you guys have, if any. Cool. Let me see. Whoop. Thanks, Sean. Clear explanation. One owner. Awesome. Okay. So here's a question from Willem. What happens to my dividends? Okay, so when dividends are declared and gets paid out, it will go into your share trading account. It'll be obviously there as cash. Best way to look at it is going to PSG Online. There's a tab called Cash Reports, I think it is. And from there you can see how much dividends was paid, and also the dividend withholding tax. So it's all there, transparent for you. Okay. Remember, if all the dividends gets taxed 20%. That's dividend withholding tax. So just understand with corporate actions, you as a direct client, I'm talking now to specifically the people that are direct clients with PSG Wealth, you sign a mandate where you're responsible for your own shares. Okay, for that. So you self-managed, you sign the mandate, you're responsible for being aware what's happening with your shares. Okay, we as direct client, as investment specialists or client services, we are there just to help you, to assist you, make it easier. We act as a middleman with these corporate actions. So please make sure that your email address is correct on our system. If you change your email address, we don't know about it, you won't get these corporate actions. Okay, so that's number one. And number two, obviously be aware. Look at your sense announcement. Be aware. Follow what in the media, what's happening with the companies, business day articles, etc. Okay, I'm sorry I'm hopping on this. Here's another question from John. Can I sell the no-paid letters? Yes, you can sell them in the market. Okay, please take advantage of that. That's where I saw so many people lose opportunities in the market. If you don't want to take your rights, sell your rights. Gee, I saw this one example, and just using one example. I saw this one shareholder with EOH. She only had 7,000 no paids, but they were worth 43 cents a no paid letter. 7,000 times 43 cents. They were worth about 3,000 rand. Those things over a period of time, over 6 weeks, become zero. Okay, but when they first come out, sell them. So yes, there are brokerage costs involved. So yes, it's going to be 157 rand plus VAT, whatever the case might be. It's about 5%, but you're still making 95% profit on that no paid letter. Take advantage of it. I saw people with 200,000, 400,000 no paid letters being wasted. Sell those rights if you don't want to take it up. If it's too small and you've got a small shareholding and it's not worthwhile selling because the cost will be too high, then let it lapse. But please do something about it. Okay. Well, I hope you guys got the message there. Okay. Money on the table. That's what I meant by leaving money on the table. Cool. Doesn't look like there's any questions here. left over. But guys, from my side, thank you very much for being on this webinar. I hope you enjoyed it, found value in it. Any questions, as I say, please drop me an email. I'm there to help you. And as I said, this recording will be sent out the next day or so. Okay. So from my side, thank you very much for being on this webinar. Until next month, all the best. Bye for now.